Hey everyone, welcome to another Market Radar podcast. It's April 30th, 2022. So after this week, it's looking a little more rough than last week. S&P is down 13.26%, Nasdaq is down 21.26%, Russell is down 16.86%, Dow Jones is down 9.26%. All of these indexes are in bearish trend, and as we like to say, bearish trends lead to lower prices. And honestly, it does seem like we're just getting started. S&P being down only 13%, that's not much. There's definitely a way to go, and with Apple being at the levels that it's at and being such a big weighing in the S&P, it's not too far fetched to see us going lower, especially with HYG heading lower as we've been talking about. Our matrix is saying 71% chance of risk off. I'm actually not too sure if this is the highest we've had since 2006. We actually want to check back on that, but that does seem like a very high number. Confidence level of 86.7%. Our model is very confident we are in stagflation, and so are we. We just trust our model, and everything is definitely playing out how we've been expecting it to play out. And if you follow us on Twitter, we've been saying, pretty much calling out everything that's happened since January. So let's get to the economic calendar. Got a pretty big week. Monday, we have PMI manufacturing final, ISM manufacturing index, construction spending. Tuesday, we have factory orders and jolts. Wednesday is the big day. We have ADP employment report, international trade in goods and services, EIA petroleum status report, and then we have the FOMC announcement and the Fed chair press conference. So we're expecting a double hike, so 50 basis points hike. Yeah, that's probably what they're going to do. That's what they've been saying they're going to do. Thursday, we have OPEC meeting, jobless claims, productivity and costs, EIA natural gas report, and the Fed balance sheet. And Friday, not much. We have employment situation. So let's take a look at what ES did this past week. We did have major drop off at the start of the week, but then a counter rally, which didn't last too long. Complete reversal on Friday, back to the lows. We're expecting to see lower lows. We're expecting to break the low that we saw on February 24th. Judging by the way HYG is moving, it's definitely going to bring down the S&P, and the S&P is going to catch up with it, as it always does. Let's take a look at ZN. As we mentioned last week, you're trying to catch a falling knife. It's not the time to catch bonds right now. We had a little relief rally, which I don't know if I'd even call that a rally. 3 days, and it already turned around. We are expecting to see lower lows on this as well, based on our real yields theory that we have. So let's get started with talking on, actually, today we have a pretty exciting episode. We want to talk about stagflation. So it seems like people are finally starting to realize that we're heading into stagflation. Late to the party as usual, but we want to talk about it today and talk about what stagflation really is and what it means for us regular people. But first, Gamma is going to talk about the Fed rate hike that we're expected next week.
Okay, so I'm gonna pull in the Bloomberg rate probability matrix, and we're gonna take a look at what we have going on here in the next two Fed meetings. I tend to not look past two Fed meetings because things can get kind of wonky out on the outside of the curve because the Federal Reserve is a very slow moving. They're like a sloth. Okay, they're not on top of anything. They kind of just roll around and crawl around, and like they won't. What we expect them to do will not really be accurate 12 months down the road because they can pivot if things deteriorate, and they probably will. But we don't know when the deterioration is going to come from what they're looking at. But what I can tell you is that the Fed funds futures are pricing in 2 rate hikes in Wednesday's meeting, and then a preceding 2.5 rate hikes in June's meeting. Now, obviously, there's not a simple way to put this, but we're going to go up to in May's meeting as of what the futures are pricing in. So we're going to go from 0.25 to 0.75. And then in June's meeting, they're basically implying that we're going to be at 1.1 1.5. So they're expecting that the federal funds rate by June, so the half year mark of 2022, is going to be 1.5. For reference, in January, the rate was zero. So we're moving 150 basis points in 6 months, which
Well,
is
so
very
when
quick.
when was the last time we saw 1.5%?
That's a good question. So let's take this up and let's go.
I just want to know like
Yeah, yeah, yeah. It's a good question.
how
Let's
off
see.
guard are is the economy going to be?
Go
I
our
feel like we
chart.
were there just before COVID, so 2 years ago maybe.
Right. So let's go to uh so 1.5. That was right before COVID.
Yeah,
Right before COVID hit, we were sitting at 1.5. Yeah.
back in
That's the
like
effective federal.
start
Yeah.
it started in like October, right? Yeah.
What, COVID?
No, I mean like they cut down to 1.5 in October
Yeah,
before
yeah,
COVID.
yeah,
Yeah.
yeah, yeah, yeah. Exactly. They cut down to 1.5, and then they really had to accelerate the cuts into COVID. Yeah. But if we go back to the interest rate, the Fed funds futures matrix for interest rates, we can see that we're looking at 2 hikes and then another 2.5 hikes, meaning by June, we're looking at 4.5 hikes from today's rate, putting us at an implied rate of 1.46%. So let's go on to understanding what is stagflation. Like you said already, we're looking at stagflation today from a bigger or from a wider lens, right? Everyone's talking about it. Everyone's chirping about how stagflation's here now. We're screwed. Stagflation's terrible because they only know one thing when they hear stagflation. They think of 1980s, right? They think of this whole like complete disaster where the Federal Reserve had to open the doors or the floodgates to rate hikes and had to push rates north of 10% to curb inflation. So people hear stagflation, the first thing they're going to think about is 1970s and 1980s. If you're talking to someone that's um, studied the history, or I should say, the passive American monetary policy.
Yeah.
The
And
first thing they're gonna say.
well, I'm sure
Yeah.
most people that are listening to this weren't around back then. We weren't around
We
back
we
then.
weren't. No, yeah, we
So,
were not.
we want to shed some light on what this really means because we really haven't seen this level of stagflation. I mean, we're not even at the levels that it was at in 1980,
Right.
1970s, but even the level that we're at now, we haven't seen it since then. So, I think it would be great to talk about it.
Right.
We did some research on it and just compare what happened then compared to what's happening right now.
So I think a good place to start is for those that are listening. Let's describe what is stagflation. So stagflation is simply put uh, when GDP peaks and CPI is still rising. So when GDP or growth is peaking and more, I should say, it's already peaked, it's not slowing, and CPI is rising, you get what you call stagflation, where the costs of things are going up, but the production side of growth is no longer there. In inflation, a CPI, or the consumer price index, rising, right, is is a good thing. So this is the big difference. Like, to sum this up and put it simply, inflation and stagflation. People will tell you that inflation, the price of goods rising, is terrible for the market. When people look at the consumer price index from a bird's eye view, they say a rising consumer price index is good for stocks. Some people will say, or a rising consumer price index is bad for stocks. What they don't understand is the differentiation, or I should say, looking at it from a specific point in the curve of the cycle, right? So you have inflation rising in the inflationary regime, but GDP is rising with it. So what happens is credit quality improves, and credit spreads, or risk spreads, narrow. And that's a risk on opportunity. A lot of things go up. There's really hardly anything that gets destroyed from a risk asset standpoint in inflation. Stagflation, on the other hand, is a complete risk off scenario. What ends up happening is growth slows while inflation is still running. So think of it like growth is already falling, but inflation is lagging and it's still running higher. So you have people that might be losing jobs, or making less money, or making the same amount of money, right? Because the companies they're working for are no longer growing, and the cost to live, or cost of living, continues to rise. So people really feel pressure because they're suffering from the ability to maintain, like, basic living standards. Like, for example, pasta might go up, meat might go up, but their salaries won't really go anywhere. Whereas in inflation, you're more likely to get a raise. You're more likely Companies are more likely to basically hand out bonuses and so on. Where in stagflation, it's not the same, because people are not making, or don't have the opportunity, because the growth is no longer there in the economy. And that's what the economic regime cycle tries to encompass. We try to get the whole part. This is basically a sine curve from peak to trough. Peak being stagflation, trough being expansion, and we're trying to capture the equity returns along the curve. So let's go into a better conversation that we can have here. Besides explaining what stagflation is how is stagflation different? If we look back in time, right, we go back to the 1970s, 1980s. Most people will tell you, stagflation was everyone was talking about it. It was in the news. The Federal Reserve was basic. Paul Volcker was, televised, and hated at the beginning, loved at the end. It was a story. It was a tale. It's an old tale for anyone that lived through it, right? So let's bring up a chart first, and let's go back to 1969 to 1970. Prior to gold was trading at $35 an ounce. This is, before Bretton Woods. This is what was going on. Gold
The
was
good
35 an
old
ounce.
days.
The good old days, right? Um, Before we move further, let me explain what these lines are on the chart. So we have this purple line, which is the gold futures, or I should say gold price, not futures. The blue line that you see here is what we call the misery index. Okay, this is not created by us. It is a simple index by adding the rate of the inflation rate year over year to the unemployment rate. You add those two together, and you get the misery index.
So
The misery,
essentially it's high unemployment and high inflation. People are miserable. So
there you go.
that,
That's a great way to put it. And I also have a white line on this chart. Now, the white line is real yields. So let's go back to stagflation in the 1980s. As you can see here, the misery index is very high. If we look at the unemployment rate, I just added that in. It's the orange line. It's very high as well. I'm going to take that out. So understand that if the misery index goes up, generally the unemployment rate and the inflation rate are moving higher as well. So in the 1980s, we have this issue where we have record unemployment, or I should say extremely high unemployment and extremely high inflation. And we see gold ripping. So a lot of people are looking at this from a perspective of saying, like, oh, well, gold is going to protect us against stagflation, right? or gold is going to protect us in this stagflationary environment, which we have not seen such a magnitude of stagflation, at least back from when our models have tested since 2006. So even throughout the great financial crisis, there was no stagflation like you're seeing today. So let's take a step back even further and understand, why did gold rise? Why did gold go higher in this stagflationary regime? And why is gold not much higher today? Because the first thing when you say stagflation, the first thing that someone's going to do is going to say, "Well, let's buy gold," because they look back in the 1970s, 70s to the 80s, right? And they say, "Well, gold, gold went from literally 30, 100 or $35 an ounce, technically, all the way up to a high of, I think it was like 600, 700 an ounce." Like, that's record. You're talking about over almost a 20x.
Yeah, that was like the Bitcoin back in the day.
That was the
That
Bitcoin
was their
back in the day,
Bitcoin.
right? So you hear stagflation, the first thing that most people are going to tell you is, "Oh, buy gold." Well, the reason why gold did what it did was because you had a problem. Well, first off, real yields, we can't go back that far in history and look at what real yields are. And let's clarify for everyone that follows us and pays attention to what we're doing. Real yields are nominals minus break evens. It's not nominals minus CPI. What are nominals? Nominals are, you look at the 10-year yield and it's yielding, if we pull up the 10-year yield right now, it's yielding 2.93%. That's a nominal, right? It's face value. 10 years yielding 2.93. Break evens are, what are the break even? I don't have the break evens up here, but they're roughly around two. They got to be around 2.9, or what, 2.9 something. That's what the last time I checked. So you take nominals minus break evens and you get the real yield. Now, what are break evens? Break evens are the anticipated inflation annualized throughout the duration of whatever term you're looking at. So, like, let's just say we're looking at a 10-year yield, right? What's the break even on a 10-year yield? It's telling you that over 10 years, the break even rate is going to be, say, 2.8%, meaning on an annualized basis over 10 years, the break even rate that you have to beat is 2.8% to beat inflation.
So it's just adjusted for inflation, right? It's a bond adjusted for inflation.
That's real yields. I'm talking about break evens, the component within
Oh, I see.
real yields. Yeah. Okay. But yes, you're right. Exactly. So once you put the two together, you get a bond that's adjusted for inflation, aka a TIP, a Treasury Inflation Protected Security, right? So if the TIP is yielding, or I should say, the real yields are currently just under zero, the correlation is that or I should say, if real yields are just under zero, we believe that the Federal Reserve is going to push real yields higher. They're going to kill inflation expectations before they kill bond yields. You understand? So they're going to, this whole show that they're putting on, when they start actually hiking, they're going to crush inflation expectations faster than they're going to crush bond yields. So real yields are going to widen. That's our theory. Okay. And that's why and first off, real yields are at zero. So, we're actually slightly under on the, if you look at
We've
the
already
average.
been right.
Yeah, well,
We've already
let's look
been
at,
right on the call.
yeah, I know we've been right on the call, but let's take a look from real yields on a perspective. We have fives, 10s, 20s, and 30s, right? 20s and 30s, these are durations, right? 30 years, 20 years, or what so? 20s and 30s are above zero. Fives and 10s are still under zero. We think the whole curve is going to go positive, meaning fives, 10s, 20s, and 30s are all going to be positive. So we have a bit of ways to go, which is why we're so hesitant on the bond trade, because the bond trade is correlated to the real yields. Real yields are inversely correlated to bonds, right? Because if real yields are rising, people are selling bonds, right? If real yields are falling, people are buying bonds. No one wants to, I should say no one, right? Obviously, there are some buyers, but who wants to own, like, how many trillions of dollars wants to own bonds in negative real yield territory? That's our whole thesis, saying, like, okay, the bid for bonds isn't really going to happen until real yields are decently in the positive territory. So let's go back. This all wraps into why the stagflation is different. Real yields, they're negatively correlated to bonds but they're also negatively correlated to gold, right? We know bonds and gold are generally correlated. They're considered safe haven assets, right? Like in times of uncertainty, you buy bonds, you buy gold. So real yields are inversely correlated to both of them. Let's take a look here. In 2010, right, we have this collapse in real yields and this rip in gold. Real yields, gold really didn't start accelerating aggressively until real yields peaked. Real yields peaked and gold kind of went for the hills, and then or for the skies, I should say. And then gold peaked in 2011 when real yields bottomed, or excuse me, 2012 gold put in a lower high, real yields bottomed, real yields start accelerating, gold gets crushed. In 2018, real yields peak and start falling off a cliff, gold accelerates. So these are negatively correlated very strongly, right? They're strongly negative, they have a strong negative correlation. So if we know that that gold is negatively correlated to real yields, let's go back in time in the stagflation period and um let's add in the 10-year yield. So let's see. And you'll know right away the 10-year yield was all the way up here at where is it? 13 or 14%. The 10-year yield peaked around, I think it was like 15 or 16%. Now, if we know that bonds and gold are negatively correlated, right, to real yields, that means real yields should be much lower during this time period. They should have been falling. Okay.
Do you think
But
they were negative?
I don't know if they were negative or not, but I would have assumed like with the rate of inflation that there was, and like I would have assumed they were very negative, but
Yeah.
we can't tell. Obviously, there's no break even data, right? Because remember, when the real yield component, you have the nominal, the face value, and then you have the break even, the adjusted for inflation. The adjusted for inflation wasn't around back then, so we don't know the market structure for pricing break evens didn't exist, so there's no break even data going back that far. But let's take a look at today. So the reason why people um, are very confused when it comes to stagflation is because real yields have been. Let's take some lines off this chart so everyone can see. So so don't mind the blue in the background. The blue is
That's the
the
misery
misery index.
index,
Yeah,
right?
that's the misery. That's a misery index. So what we have here is we have the white line real yields and the pink line the nominal, so the 10-year, what you see priced on your computer. Right now it's 2.93. That's what the pink line is. So they look very correlated, right? The nominals and real yields are flowing in tandem. Which earlier when I said real yields go up, bonds go down. Real yields go up, gold goes down. You might say, okay, real yields and gold and nominals are the same thing. So if yields go up, gold goes down, bonds go down. Now, in the last 20 years, yes, you're right. That correlation is there, which is why some people say, okay, or I should say, most people don't know about real yields for this reason, because there was no actual reason to understand the difference between real yields and rates, because they're so correlated in the last 20 years that if rates are going up, the assumption was, or theoretically, real yields were rising too, would in whatever period that you were looking at, like back here in 2013, if you were looking at real yields rise, um, so we're oh excuse me, if you were looking at the nominal yields or bond yields on TV, the ones on Bloomberg, on CNBC, those rising, well, real yields were too. So you kind of got it right. But remember, we know that real yields are negatively correlated to bonds and to gold, right? The positive correlation here that we look at in the last 20 years between rates and bonds and gold, right? They're not, we know that they're inversely correlated. So we know, like I just said, that if rates up, gold down, bonds down, right? We established that. So let's go back to stagflation in the 1970s and 80s, between the 70s and 80s, right here, where we have this misery index explode. The 10-year is going to 15%. Well, if you take the analogy that the 10 years going to 15%, or I should say the idea that the 10 years going in your head that the 10 years at 15%. What's your first thought, Artie? What are you thinking? Where's gold?
Oh, well, gold is going to be coming down, right? Because it's inversely
Right,
correlated.
right. There you go. Gold's going to crash, right? So
Yep.
the idea that rates are going higher should kill gold. Let's add gold back on this. Gold is ripping to new all-time highs. How does that make sense? And this is the big, before we answer that question, this is the big reason why no one, or people that glance over this time period with a broad scope, they don't really understand what actually was like the consequences of this type of stagflationary environment, right? They look back and they say stagflation, gold's a buy. If you were to analyze this period, you would say that gold's a buy in stagflation, right? And gold is positively correlated to interest rates. So you would say, right, on the face value that you can't use interest rates as a determination of where gold's going because they move together in the worst time in history. But what you don't realize is that if gold is negatively or extremely negatively correlated to real yields, what were real yields doing at the time, right? They were collapsing. Because remember, if bond yields real yields go down, gold goes up, right? Gold goes down, real yields go up. Bond yields are one component of real yields. So it would make sense that gold would rip with nominals ripping because the break evens were probably so big at the time for to normalize to get your real yield. They were so much, they were completely outweighing nominals that the real yield was negative or negative and declining, right? So
So you're
as the
saying the inflation rate was so high that even the massive interest rate on bonds was not making up for it to bring it to a
right,
positive
right.
real yield
Right, and it did eventually. That's the key because
eventually.
look,
Yeah.
because look at gold. Gold gets crushed, right? Well, what again? Let's spin the scenario in our head. Gold gets crushed. What's happening to real yields? They're going back up. They're rebounding because remember the Federal Reserve, right? If you think about it, the Federal Reserve hiking rates today doesn't fix inflation expectations automatically, right? So let's just say we have a real yield equation, right? The real yield equation is nominals minus break evens. The nominals are going to rip with the Federal Reserve, literally US 10-year ripping, right? We'll take gold off to make this less blurry. Gold, US 10-year ripping, right? And look at gold. Gold's ripping too. So some economists or study or people that study this time period will say, well, gold and interest rates were positively correlated. So there's no real strong correlation between interest rates and gold. Because in 1980 it disconnected completely. So how could you rely on a ratio like this, right, or a correlation? Well, remember, bond yields go higher, right? Doesn't mean inflation expectations are automatically moved. The inflation expectations are moving much slower because they're pricing over a 10-year period, right? We have events yet to happen. You understand? So the 10-year is looking at a 10-year perspective of what the Fed's going to do. But the 10-year break evens of what inflation is going to be has not been affected yet because you can't price rate hikes into break evens. You understand? Because the break evens are telling you today with what's going on, what is going to happen. Where the 10-year can be much more, or I should say easily, not manipulated, but we know that the Fed's going to hike 2 rate hikes. That's priced into the 10-year already, right? But the break evens, we have all these other variables that have to be sorted out with rate hikes. Like, supply, the first off, the Federal Reserve can't fix supply chains. That's number, they're incapable of like repairing them, right? So there's a lot of factors that go outside, I should say, outside the scope of a rate hike. Now, the break evens, to a sense, do hold some rate hikes in there. If that makes I'm not trying to say that they don't, but the consequences of the rate hikes cannot be implied, if that makes sense, right? Like how the rate hikes are going to affect the break evens cannot be applied accordingly to where they can be in a 10-year because it's just a nominal yield.
Okay, wait. So let's bring it back a little bit. So what is the difference between the stagflation we're getting now and the stagflation that we had in the 80s?
Right. So the stagflation we had in the 80s, real yields were falling off a cliff. From what I would assume, if we look at gold, the move in gold, real yields must have been extremely positive over here and got decimated. Or I shouldn't say extremely. Real yields were in the positive territory and got completely
And then
decimated.
so they probably went negative.
They probably went negative. I mean, this type of
Yeah.
move in gold, right? But there's also like let's take a step back and there's a hype factor, right? Gold was now like what Bitcoin, what like people the way people view Bitcoin, gold was a little bit more conservative, right? Because it was backed by a dollar, like it was actually like some backing, right? Some structure behind it. But it was ripping. Like you're talking about a 20-fold move, right? Like there was some hype there. Don't if you don't think that people in the 70s or you know some just go ask some elderly individuals that lived through this time period, the 70s and the 80s. Like or I should say the 70s to the early 80s. We're talking 81, right? So from 70 to 81, gold was a hot commodity. Gold was not something that like, you know, everyone knew what gold was. It was moving. Everyone heard about it, right? It's like what Bitcoin was in 2017. Remember, everyone and their mother wanted to get in Bitcoin.
Yep.
It's the same type of analogy with gold.
Yep.
Gold had that presence, which if you talk to a lot of elderly people, they tend to have this sweet spot for gold
Well, so
because
so
because
hold on. Let's go back to what you said about the real yields. So real yields back then were likely positive and they got crushed, likely to negative territory. We don't know. We're
right,
just assuming.
right,
But now we're having the opposite where we're in negative territory and real yields are going up.
right, and
So
that makes the stagflation different
so
because
how do you play that differently then?
well this rise in gold and this rise in gold, right? And this rise in 10-year yield, right? Or I should say the rise in interest rates and the rise in gold in the 1970s and 80s. Bonds were we look at bonds, they were rallying as well, right? That real yields are up, gold's up, bonds are up, real yields down, right? That's how this works. So if you look at it from a perspective of what was going on back then and you compare it to what's going on right now, like if we look at what's going on today, we have gold up, right? Rates are moving higher, but real yields are moving with them. Because I don't know how negative we went over here, but I mean, real yields have bottomed because there's no bid at this point. You understand? Like we are now we I guess to simply put it this way, let's take a step back and look at what real yields are doing. Real yields are going higher because no one wants to own negative yielding debt with rising inflation. You understand that?
Yep.
Like I think that real yields bottomed. I don't the thing is it's really just an assumption because I don't have break even data, but I can tell you that from the understandings of correlations between real yields and gold, real yields were getting clobbered throughout this time period. But let's just take a look back here in in 2003 when we got some real yield prints. We're up at 2%, right? 2% in real yields. And I mean, did we just come from like all the way down in negative territory? Or were we going all the way where real yields much higher, much higher and drop down? You understand what I'm saying?
Yeah.
Like
Yeah.
like we don't know the starting point at 1969 of where real yields really were. But odds are every time we've seen zero I should say negative real yielding debt, it's reverted, and we saw it back in 2012. It reverted rather quickly, and now we're doing another reversion process where we're going above zero. But when inflation peaks and real yields, or I should say, when inflation burns out, right? When inflation peaks, we get what we call deflation. And in deflation, the bond trade goes back on, right? So the way that this stagflation is a little bit different is that we don't have a massive rise in rates. We don't have this whole euphoric move in gold throughout this whole stagflationary period because real yields are starting from a negative territory. What I'm trying to say is, from my assumptions, I believe, obviously, no one can test this, but from what I can tell from looking at the market, real yields did not start stagflation in zero in 1969.
Yeah, so they got stagflation with positive real yields.
Right. They got stagflation with positive real yields. In turn, they got the bid in gold. They got the bid in bonds. You see what I'm saying? They got the bid. They got the real yields were still positive, right? So they got they probably got the equity bid too for a while.
Damn, so they had a good they actually had places to put their money,
Right,
whereas
because real yields were still
right
positive.
now, like there isn't really any place to put your money with confidence. I mean, commodities were the place when we got our first stagflation trigger, but now there really isn't anywhere to put money with confidence.
And I think a way to simplify it, because I know I've probably talked all over the map here, right, through different angles and subjects about
Yeah,
real yields,
simplify
nominals.
it. Simplify it
Simplify it. I
for
think
everyone.
I guess a good way to simplify this would say that back in the stagflation that everyone talks about, that you will hear on TV when this, we get the second drop in GDP.
When
That's
it
what
goes
everyone's saying.
mainstream.
When it goes mainstream is what I'm trying to say. Um, that stagflation is not going to be the same. That they're going to talk to you, they're going to bring an angle to the public of like stagflation 1970s, 1980s, this whole idea that, oh, are we going to get stagflation like we did back then? Powell is not Paul Volcker, like he's not going to be able to curb inflation. In reality, the retrospect of where yields are now are completely different, right? If you The retrospect of where yields were, where they are now, completely different. Real yields are negative moving higher, meaning, remember, for a deflationary play, we need CPI to fall and GDP to fall. We're not going to get we're not going to get deflation with with a rising real yield. So real yields need to peak before we get deflation, right? Because for deflation, remember, we don't look at it from an economics point of view, data feed line where we have our GDP and CPI models or whatnot. We have a market price model. So for the market to price in deflation, what has to happen? Well, bonds need a bid, gold needs a bid, dollar needs a bid. Dollar already has a bid, right? And real yields need to go down, because if gold and bonds have a bid, real yields are getting the sell. But how are real yields going to get the sell if they're not in positive territory yet? Because you're implying that yields are never going to be positive again in America, right? Because you're saying like, oh, the next deflationary cycle is going to bring real yields lower, so we're not going back to positive territory. Which negative real yields is from, as what history is telling us, even back in 80, 69 to 80, that time period where we might have had slight negative real yields. I don't know if they were substantial. Again, we can't test that. It's obviously not something that has remained, because in 2000, here in 2004 or 2002, we had real yields up at 2.2%, meaning we were 220 basis points over. Now, I think real yields will go a lot higher. Number one, real yields should go much higher, right? Across the curve. We report the average real yield across all durations. So if we take the fives, the tens, the 20s, and 30-year bond durations, we compile that into an average. We report that on almost a daily basis on Twitter. We are just at zero, and I think it's like 5 basis points or something like that. It's flat. There is no acceleration there yet, but we think that's going to accelerate. Meaning we're going to have this period where it's not like the things that worked in 69 to 80 aren't going to work today for that reason, which is why the stagflation is different. You have to look at it from a perspective of real yields. Real yields going up, okay, is going to kind of throw a wrench in the idea of what people know and understand for stagflation. Remember, everyone that's going to be telling most people, not everyone, that's going to be telling you about stagflation on TV is going to be 30, 35, 45. You know, they're going to be in that 45 area. You're going to get like Joe Kernan and some of these other guys at CBC, right, that are a bit older. And then you get like Steve Leisman, right, who's, you know, somehow in bed with Jay Powell, but that's a different story. You're going to get him, they're going to get them talking about real yield, or I should say, stagflation. They're going to be referencing what they learned in school about stagflation because that's what was, you know, big and hot when they were in school back in the day, right? I shouldn't say 35 is back in the day with,
But yeah,
you know,
no, they're
yeah, you get
essentially
my point.
essentially they're gonna have no idea what they're saying.
Right, that's my point because they're going to be talking about stagflation from a perspective that they don't understand the component of real yields this time. Real yields. There's been a bunch of people on Twitter that call it deflation. There's been or I should say, the bond trades on. There's been a bunch of people that have been screaming the gold trades on. Now, could gold like rally? Yeah, it could. I mean, it's bullish DDAP trend, so it really could rally. But we are not fans of it. We think it prints lower, but we're not long and we're not short for the reason of real yields, right? And let's do a quick overview on the thing we've been talking about a lot lately is, and this is important into the next Fed meeting. We're going to keep this nice, short, and simple. The federal balance sheet is going to be reduced. The Federal Reserve is going to trim their balance sheet. So take the trimming the balance sheet aspect. Okay, they're cutting, they're tightening into an economic slowdown. Number one. Number two. What does that mean for the market? The Federal Reserve balance sheet or the United States Central Bank balance sheet is a indicator of market liquidity. Now, just because as the balance sheet rises, it is you could look back in time, it's a volatility suppressor. So it's a market liquidity enhancer. As the balance sheet comes down, it's a volatility enhancer and it's a market liquidity um I should
Decreaser.
say depressor, right? So as as VIX goes up, the more VIX go, the much higher, or I should say, the higher VIX goes, the less liquidity there is in the market, right? Because people have to now stomach bigger price swings, so on and so forth. But why is the VIX going higher? Why is the VIX allowed to trade higher? It's because market liquidity is decreasing. Why is market liquidity decreasing? The Federal Reserve is pulling assets off their balance sheet. And this is something to watch in the next couple of weeks. What happens with the federal balance sheet, the direction of QT, which they're going to go over on Wednesday, and the magnitude of what we're going to see in reduction wise of the Fed balance sheet. Look back in 2018. Let's take a look. The federal balance sheet from 2014 to 2017 was rather stagnant, right? VIX kind of chopped up. It had these pops, but it was, it was a sell of all environment, selling volatility paid, right? But the financial stress index, which we went over in a prior podcast, or market liquidity index, rose, showing a decrease in market liquidity, and it kind of petered out and whatnot. But then we have this balance sheet starting to be reduced in 2018, slow and steady, all throughout
Yeah, and
2018, right?
there you can see the VIX
Right,
became a lot
and
more volatile.
VIX became a lot more. VIX came a lot became like or came to life, I should say, right?
Yeah.
And you could see the market liquidity is starts chopping around, right? It really doesn't do this whipsawing, right? You see it like going up nice and slow, down nice and slow, and it starts whipsawing in multi-month periods. Well, that's because VIX and market volatility are correlated. If we scroll out in the chart, you'll see what I mean. VIX goes up, market liquidity goes down. And remember, market when the orange line market liquidity goes up when the line goes up, liquidity is going down, right? So VIX and market liquidity are pretty much correlated to the fact that when they move in tandem. So what you notice about these time periods is whenever back in 2008, the Federal Reserve started this QE thing, right? This thing that we call, I mean, there was somewhat projects outside of QE, but it was more mainstreamed in 2008, right? Um, Look what happened. The 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 VIX and the stress index, which we call market liquidity, they peaked as soon as the Fed like pushed this whole balance sheet up, right? They basically it's a vol suppressor and a market liquidity enhancer. And as you notice, every time the Fed pumps the balance sheet, there is no issue with market liquidity or volatility. It's a volatility suppressor. Look in 2010 to 2011, VIX had one pop, sell the vol environment, and market liquidity was really good. Then you have this cutoff here in 2011, right, where the balance sheet starts fading, VIX up, market liquidity um, decreasing. And this is something that you can look back in time, and it's very simple. The Federal Reserve is going to enhance volatility and decrease market liquidity. That's what's going to happen. It's just a matter of how aggressive it's going to come based on how aggressive the Fed's going to be, and that's something we're going to watch in the next few weeks. But I think we should cut it here for this week, and we'll revisit this topic at the start of next week's podcast when we hear some more information from Jay Powell.
Yep. Thanks everyone for listening. If you're new to this and you were lost for 99% of this podcast, which I don't blame you, it's not easy stuff, but we got a Discord channel. Everything's for free. We're in there. We have a Twitter. You can reach out to us over there and ask us any questions. We're happy to help. Thanks for listening.